Good evening, guys, and thanks for joining us. This is our latest mortgage seminar webinar, and I try to do one of these every couple of months just to give people access to a little bit of advice that, sometimes can be hard to get because it can be hard to get an appointment with a mortgage advisor because the market is so buoyant. Mortgage advisors are hard to get a hold of at the minute, and we try to make ourselves available as much as we can, but it's always nice just to have a bit of time in the privacy of your own home as well. So today, guys, is really about me sharing a few ideas. I'm going to talk about changes in lending criteria, and a lot of these changes come in 2 weeks ago. So a lot of it's going to be prior to 2 weeks ago and now, because a couple of lenders have come into the market, and one particular newer mortgages have really changed what's about to happen in Ireland. And you're going to see that through the presentation. I'm going to tell you, listen, what traditional lenders do and what new are doing differently. But they have changed the landscape quite a lot. So we'll talk to you about that. We're going to talk about a few ideas and possibly getting you through the mortgage process a bit quicker, a bit easier, and a bit less friction with the lenders going forward. So let me share a screen with you, and we'll get started, guys. And we'll, as I say, if there's any questions or queries or anything as you go through here, don't be afraid just to put up your hand. I'll actually unmute you if you like, and you can actually ask your question. Or there is a text box or a question box there. So by all means, if you would like to just get involved with that as well and send your texts to it or your questions to us, that's fine. We'll review the questions as we go. But here's where we are, guys. And the caption here is because smart decisions start here. And by actually engaging with a mortgage advisor, that's probably one of the best decisions you actually have made, is to kind of get advice first. So that's pretty much where we are, guys. And if this would move, it would be handy. Okay. So a little bit about who Advice First are. Guys, I've been advising in the financial services since 1992. 2005, I decided to open Advice First Financial, and we've been advising since that around mortgages. But really since 1992, I started in the financial services, and I've been advising on mortgages and life insurance and mortgage protection and the full range of financial services. I mean, obviously, Advice First is members of the Professional Insurance Brokers Association. We're obviously regulated by the central bank, and we are also members of Brokers Ireland. So we are very much affiliated with all the central or with all the regulated companies that you would think as well. So what we're going to talk about, guys, and this is kind of loose. I'm not going to stick to this. We're going to bounce over and back, and we're going to just have a general chat about this and what's going on. So what we're going to look at is, well, first of all, how much you can borrow and what lenders look for, what challenges, where's the friction points that we find all the time. And generally they're all very similar. What deposits are needed hasn't really changed much. Cashback offers, they've tweaked and changed a bit. Help to buy schemes and first home schemes, we're going to have a look at those and figure out, well, listen, where can they be applied and what's good about them and what's bad about them. We're going to have a look at paperwork needed and just the process in general, guys. So it is fairly loose. Any questions or queries as we go, by all means, fire them up to us and we'll have a look and have a chat about them. Okay, so the first question we get all the time is, how much can I borrow? And on the face of it, there are two ways to actually calculate. There are two calculations that we have to run to work out how much you can borrow. And one is, first of all, we have to look at your financials. And obviously then it obviously is based then as well on the property value. So when it comes to your financials, what you hear all the time is 4 times income. You're allowed to borrow, as first-time buyers now, you're allowed to borrow 4 times income. And you are. But, and there's always a but, and this is what catches people out. Banks run more than just one calculation. It's more than just 4 times income. And one of the most important and one of the ones that catches a lot of people out is a thing called net disposable income, or NDI. The reason it catches people out is because nobody talks about this. But when you go to your bank or go to your lender and they say, okay, you haven't got affordability, and you're going, well, what happened to 4 times income? It's because of your NDI. This takes account of all other expenditures. And I'm going to run through a couple of examples, and we're actually going to do a couple of calculations as well. So I'm going to take you behind behind the veil, hopefully, if I can get it to work. I'm good at what I do, but techie wouldn't be my strong point. But hopefully, we'll manage. You can just be patient with me, and we'll get through it. Proven repayment capacity still is a requirement, and this is one of the places where we're going to say, listen, pre 2 weeks ago and now, proven repayment capacity was a big issue 2 weeks ago. It's not now. New mortgages come in and they've just scrapped that. And it took me a while to get my head around it because for years and years and years, we were sending people away, listen, you haven't shown me you can afford the mortgage. The bank would say, listen, when we look back over your last 6 months, you haven't shown us that you can afford the mortgage. And they send you away for 6 months and you've got to save and you've got to do this and you've got to do it. Gone. They are new, have just ticked that and said, no, don't need that anymore, which is absolutely fantastic. They are changing the world, guys, when this and for mortgages in Ireland. Affordability calculation, this is a stressed interest rate they use. So again, this is one that catches you out. And rather than talk about it, because it's hard to sort of see what that's all about, I'm going to actually show you some calculations on it. Well, to say, we'll jump out of the actual presentation and we'll jump into a calculator in a second. When it comes to on the property, how much can you borrow? For first-time buyers, 90% loan to value. That's been the number for a while. Now that works for first-time buyers. It works for movers if you're selling your house and you're moving on to another house, a bigger house, smaller house. 90% loan to value still works. But if you're moving and keeping the house that you've got, which we would have quite a lot of people doing, so you want to trade up, but you also want to hold on. Maybe you've got a small mortgage on the existing house, and maybe you want to have a look, maybe dip your toe, maybe renting the house and holding it on, or maybe as an investment property or a retirement fund, which is all good advice, by the way. But if that happens, then your loan to value for most lenders will be reduced to 80%. Now, we have seen, and we have been able to get higher than that in some cases, but it is generally 80%. But in case per case, it can push up. And I just put a please note in there that the percentage, when we're talking about the 90% or the 80%, it is of the purchase price or value, whichever is least. Now, let me say that again. The percentage that the bank will give you is based on the purchase price or the value, whichever is least. Had a case quite recently where there was 3 or 4 bidders on a house. The house floated at 180k and was actually sold for 230, 240k. It was actually in Donegal. The issue being is that the value wasn't at what the person had committed to buy. So the bank said, listen, bank's value went out. He said, listen, the property is actually worth only about 220. The bank will reduce on the or lend on the 220, not what the client paid. So it is important, especially in the Dublin market, if you're from Dublin, where property prices are up really, really up there. It can happen. Doesn't happen very often when the valuation comes back in less than what you've paid. It doesn't happen very often, but it can. So it's an important point. So what I want to get back to is this: how much can I borrow? And I want to show you a couple of calculations around this. And hopefully, if I can get this to work, if my keyboard will let me to get back out of this, so as I can stop sharing there for a second, and let me reshare. It's just that one of my screens is not working very well, but we have a backup here, so hopefully. No. Guys, can you see this now? Guys, I'm going to have to change computers here. I see there is a problem here, unfortunately. So tech is normal. It's letting me down here. Guys, can you let me know if you can see a yellow calculator on your screen, please? Okay, cool. So guys, again, apologize about this. It is going to be a little bit mixed up here, but let me just try and work this for say technology is letting me down here a little this evening. Okay, so what we're doing here is we're actually running a calculation. So one of the things that I do is when somebody meets with us in terms of trying to figure out how much we can get. So I've just got a client here called Rosie and Jim. For those of you a certain age, you'll know who Rosie and Jim is. But anyway, okay. So first of all, it's a joint application. Yes, it is. Applicant's age, we're going to say 34 and 33. And what we're actually doing here, this is a live calculation. We're actually walking through to see, can we get approval in principle for Rosie and Jim here? We're going to say that nobody is self-employed. We're going to say that they're married. Now, married doesn't actually make any difference when it comes to a mortgage application. The only difference it actually makes is in your taxes. So the tax, the allowable income that we can use when a married couple is different when they're married. Okay, let's say for argument's sake, they have no children for a second, and they are first-time buyers. For switchers, I'll show you another example for a switcher as well. So there's no childcare. Let's say they have a short-term debt, and this is important, guys. Short-term debt can be maintenance. It can be car loan. It can be child benefit if you've got kids. It can be any other commitment that you've got, and they do take it into consideration. So let's say it's a car loan. They also take into consideration other properties that you may or you may not have. So for this instance, we're going to say that there is no other property. Are we buying a one-bedroom apartment? This can be different. And in some cases, some lenders don't like that. So we're going to say for this instance, say no. Are we doing a self-build? For this one, we're going to say no. Property value, let's pick Donegal just for the crack. Let's say that it's 280 grand. Yeah, it's hard to know whether we'll even get a property for 280 grand now, but let's say that. Purchase price obviously then is going to be the same price. So if we're going to say this, and the value of the house is going to be what the value or the purchase price. So as a first-time buyer, then you can borrow up to 90% of that value. And remember, what we're working out here is what will the bank actually lend us? So potentially you can borrow 250,000 euros. And let's assume that we're going to do that for 30 years. And again, all we're doing here is putting in the calculations to sort of work out, well, listen, what lending is possible? And here's where the income comes in. So let's say Rosie is on 35 grand and Jim is on 32. Let's just say that. Now, some lenders, and in fact, most lenders also take in any pension contributions that you have as well. So for this sake, let's put in a pension contribution of 2,000 euros and 1,000 euros. And what we're looking for is green lights. So you can see that I've got all my green lights. So what they're saying to me, here is the 4 times income piece here. So loan offer, or the max loan amount is up to 4 times income, which is 268,000 euros. Now we're only asking for 252. So we've got a green light there. You can see here that the net disposable income amount, or NDI, and this is the bit that catches a lot of people off. So when it comes to NDI, the remaining income has to be more than what's required. So required actually means that you must have it. You must have 2,250 quid if you're a couple to live. It's only money above that that you can actually borrow on. And for what we fed into the computer here, you can see that borrowing this amount of money for Rosie and Jim, their net disposable income is still 2,626 euros a month. Hence why we get all green lights. Now, if I went up and I said, well, listen, Jim's income is actually only 15,000. Even though you can still borrow 4 times income, now look what has happened. Because the net disposable income amount has now reduced below what is required. And now the 4 times income doesn't work anymore. They've actually reduced the amount of lending to 158,000 euros. So this is where net disposable income comes into consideration. So let's put back up Jim's income. I don't even remember what I said, was it 32,000 maybe? Okay. Now, a lot of the time we get questions as well, what happens if children are involved? And can I borrow more or less if a child is involved? And let me show you. So I'm going to give Rosie and Jim some children, and I'm going to give them 2. So straight away, you can see now what has happened. Now the net disposable income requirement has shot up, which means that we are now in a position of deficit, which means that they have now reduced the income less than 4 times income again. And that, guys, is vitally important, because when you hear 4 times income, yes, but, and there's always buts, and this is the buts. And this is the bit that the banks don't generally show you, and you don't actually see what's going on. So this is why I want to do it. The other one I wanted to show you is this stressed repayment amount here. So stressed repayment is basically where the banks take the amount that you're asking over the term of years, and they use currently an interest rate of 6.75%, and they work out what the mortgage payment is going to be. And in this instance, they're stressing it at €1,600 a month. That now becomes the number that you have to show that you can afford. And traditionally, we had to come down here to the bottom, and you can see that there's a kind of a red light here as well. And this is where the weighing scale comes into it. And the best way I can describe it is literally where a bank puts a weighing scales on the table, and on one side, they put a weight of €1,634. And we have to put something on the other side of that scale to balance it. And this is where traditionally we had to use things like savings or rent payments that we can see. If we can see the rent going through the bank account, if we can see the savings going through, we have to put something on the other side of that to balance it. So let's say I had savings of €1,700 a month. Well, now you can see that we've got a green light. And you can use things like savings. We can use things like your rent payments. Use things like car loans that won't be there when you draw down your mortgage. Traditionally, that is where people got stuck. Enter into the market NUA. And now there's a couple of other lenders that are quite clever as well, but NUA seems to be the ones that's just gone, right, that doesn't make any sense. We're not going to use that. We don't really care what somebody has been doing for the last 6 months. That's not important. It's what do they have the ability to do that's important. So they look at the top half, not the bottom. So they look at your net disposable income amounts. They do still stress test it, but they look and see, well, listen, based on your incomes, could you afford this? Not have you been affording it, could you afford it? And if the answer to could you afford it is yes, they will approve you. And they are approving you bloody quick compared to what the traditional lenders are doing. So when it comes to running sort of to your lending figures, yes, 4 times income, but net disposable income is important. Stress testing is important. So the 4 times income thing isn't just all of it. But let me stop sharing, guys, and let me jump back into the presentation. And let me check on some of the questions. Perfect. Okay. Hopefully we're back, are we? Okay, brilliant. Okay, so guys, deposits. The deposits that are needed can come from it. So if you can borrow 90 or 80%, you can see that the deposits that you need is either 10% or 20%. The deposits can come from savings. It can come from Help to Buy scheme. It can come from First Home scheme. It can come from gifts. And now it can come from equity release from an existing property. And again, this is new. This 2 weeks ago, couldn't have done this. Couldn't have said anything to you about that at all. But thankfully, now we can. Okay, hopefully we're back on track, and excuse this for messing about today. But okay, what do lenders look like? Proven repayment capacity, stress tested. New lender NUA does not require this, which, to be honest, guys, this is changing. I think this is changing everything. It really, really is making that difference in how we get approval and how quick we get approval. We got approval for a mortgage today in exactly 32 minutes. The same mortgage approval with other lenders 2 weeks ago was taking us up to 2 weeks. It's just phenomenal. Good savings record, yes, it is important, and it's good on the CV, but it's not required anymore with NUA. Traditional lenders, absolutely still required. Income paid into your bank account, all lenders want to see this, guys. So if you're getting paid cash, which is not very much now that we see that, but if you are, that is a problem for lenders. Rent being evident in the bank account, that's a must. If you're paying rent, get your landlord to agree to get it into your bank account, because it does make all the difference here. Usual challenges, online betting, don't want to see it. Don't want to see betting on your bank accounts, guys. If you do a bit of betting, give the cash to somebody, let them do the bet for you. Do not have this on your bank accounts on the run up to doing a mortgage application. No referral charges or misdirect debits. Listen, one or two of these, there's not a problem. But if there's a series of them, it can be a problem for lenders, and they do jump on it. Non-euro incomes will be reduced by 15 to 20%. So depending on the lender. One of the questions we get a lot of the time is, can I get a mortgage if I'm working in Derry, or I'm working in the north, or I'm working with a company in London and I get paid in sterling? The answer is yes, but they'll reduce your income. Credit history, doesn't matter where your credit history is. If we can see that you've got a bank account in the UK, they will be asking you for a credit history report from the UK. Same if we see you have an account in the States, Abu Dhabi, Russia, Japan. If they see you in another country, they will want a credit history report from that country. If accounts outside of Ireland, credit history will be required from that country, and they will ask you to provide that. So we're going to look at some of the supports for first-time buyers, guys. And cashbacks are still there, and I'm sure you've seen them. If you have been in the mortgage world, you would have seen them. This is just a couple of them. Bank of Ireland, 2% cashback, 1% after 5 years. Cashbacks are good, guys, as long as the interest rate is good. I don't advise people to go to a bank because you get cashback. In fact, that's not one of the considerations. If you end up with a lender that gives you cash back, I think it's a good idea, but it's not the thing that we would check first. We would always check the interest rate first. Where is the cheapest money? Like, a good broker helps you buy money because that's your first transaction. Buying a house is not your first. For us, in terms of advisors, buying money is. And how do you do that correctly? That's the advice. Yes, absolutely, cashback forms part of that, but it's not the main driver. But there are cashback offers there. Talk with your advisor as you're going, but yes, it's part of the considerations, but it's not the only. Help to buy for first-time buyers, guys, only. Now, proviso to that, first-time buyer is now classed, if you're coming out of divorce, separation, coming out of insolvency, an insolvency arrangement, if you're coming out of any of that, you're now classed as a first-time buyer. Help to Buy scheme is available to you. Now, the Help to Buy scheme is a tax claim or a tax rebate. It looks back over 4 years, and the max that you can claim is 30 grand, 10% of the value of the house, or the costs of the property. Whichever of those three is least, that's what you get. So if the house is costing you 350,000 euros, 30k is the most you can get back. If your taxes that you've paid over 4 years is 15,000 euros, then 15,000 euros is what you're going to get back. When it comes to self-builds, it's 10% of the build cost, or 30 grand. And remember, guys, it is a tax rebate. One proviso that has caught a few people out is that you must borrow at least 70% of the value of the end value of the house. When you're buying a house, this isn't a problem. 70% is very clear. If you've been gifted a site to build your own house, that sometimes can muddy the water, in that the end value of the house is the market value of the house, including the site that you've been gifted. Big difference, guys. Big, big difference. So it's very important that you watch the numbers here. First home scheme. First thing I'll tell you about a first home scheme, it is an equity share. And the idea of the first home scheme is, if you're borrowing the max that you can get with whatever savings you've got, if you are still shy of what the purchase price of the house is, you can lean on the first home scheme to bridge the gap. But it is an equity share. An example I use here is, let's say you're buying a house at 250 grand and you pull down 10% from the first home scheme. They essentially own 10% of your house, of the value. At some point in the future, if you decide, well, listen, I want to buy these guys out, then they look at the value of your house then, and they own 10% of it. You buy them out at the equity price there. It's an important factor. Is a good scheme. We use it quite a lot where the property prices in urban areas and the likes of Dublin, where property prices are a bit nuts. Not so much in Donegal and sort of the more country areas, where property prices are still a bit reasonable. We don't need to lean on things like this as much. It is good and it is there. And it is also available for, even if you're on a self-build, but it's a wee bit more, not complicated, but a little bit more different than a self-build. And that if you own the site or you've been gifted the site, obviously if you're leaning on the Help to Buy, well, then they can't take the site into it. So if you take 10% of it, then they rise in 5 years' time, 10 years' time, when you want to buy them out. Well, obviously they have to factor back out the price of the site. So it is there, guys. Take advice on it before you jump into that one, though, because it is an equity share and it does make a big difference. So for switchers, if you are a mortgage holder already and you're looking into the marketplace to say, listen, where could I go and can I switch or should I switch? And what I would say on this one is, yes, you should and yes, you can, but doesn't necessarily mean you should. So what we're going to look at is, what are the reasons and where can this happen? And what's the difference now than 2 weeks ago? So one of the biggest reasons I say people should shop their mortgage regularly, and what I mean by that is, if you're in a fixed rate, before you jump into another rate with that lender, take a look around and see what everybody else is doing. What is all these other providers doing? What can be offered to you? And then what's the cost of actually getting it? Because just because you can doesn't mean you should. Take advice, guys. Every other broker will tell you should, and everybody's telling you need to shop around and you'll save loads and loads of money. Yes, you might, but if it's going to cost you $4,000 to get it, what's the point? Get advice. But you should shop it around. Take a look around and see what's happening. Important thing here is talk to a broker that knows what they're doing. Talk to a broker that has access to all the rates, all the products, and is able to take you through the full market. Hugely important, guys. Don't go to a broker that's, that has access to 2 or 3 lenders and that's all they'll give you, because they're not going to tell you that there's a better deal with a lender that they don't deal with. So talk to a broker that can give you full market access. The other reason we find a lot of people, and this is where a big change is happening now actually, is equity release. Up till now, there has been very much restricted as to what you could equity release from your family home to do. Traditionally, it was educating your children, it was building an extension or home improvements, it was funding healthcare. You couldn't equity release to buy a property, you couldn't equity release to buy a timeshare, buy a foreign property, pay off your car loan. You couldn't equity release to pay off personal loans. That has now changed. New have come in and they said, listen, guys, we don't really care. If you can afford it and if your house is valuable and if that's what you want to do, then we will help you do that. Changes completely. You can now equity release for whatever reason you want. But again, I say, just because you can doesn't mean you should. Take advice. You can roll all existing debts, and we get this every week and every month where we're helping people do budgets, and there's more month than money, and they want to take out one loan to cover all the loans and maybe extend the term out to reduce the monthly payments, and all of that's good advice if you're under financial pressure, but there was restrictions on what you could do. Those have now gone. But take advice, guys. Again, just because you can doesn't necessarily mean you should. So there are pitfalls, there are issues there. So take advice. Advice is vital, guys. And again, just because you can doesn't mean you should. Straight switch. Okay, if you owe 180 grand and you have 12 years to go, and all you want to do is shop that to get a better rate, then you're a straight switch. You can borrow up to 90% of the value of your house. Income doesn't come into it, because you are already paying the mortgage, so you don't have to prove that you can afford it because you already are. That's a straight switch. Slightly different, guys, if you're trying to switch and equity release. And again, remember what I said. You can now equity release for pretty much anything you want. Unfortunately, we have a lot of people equity releasing because of a relationship breakup. It could be, we have had one this week actually where somebody wants to now buy a property in Spain and needs to get the deposit. We have equity releasing for that. Can be done. Anything can be done, provided it makes financial sense. But we are governed to a little bit of calculation in that generally it's 3.5 times income. It's not 4 times income, it's 3.5. And it's generally 80% loan to value if you're equity releasing and something else on top of it. Now, we have seen that push up. For certain cases, certain banks will push that up. And there is affordability calculations to be done. But again, is possible. Speak with a good advisor, guys, that know what they're doing. They will help you through this. Yes, it can be done, but should you actually do it? Different thing. So a bit of financial advice, a bit of mortgage advice, you will come to the right decision. And that's what it's about. It's about making informed decisions, not just because you think it's a good idea. Okay, cashback offers for switchers, fairly similar to what first-time buyers can get. Guys, again, do not go with cashback banks just because you can. So the mortgage process, guys. First-time buyers and switchers. Again, this is, we get this kind of a question all the time. First-time buyers, get advice. There's the best advice I can give anybody, is get advice. Do not walk into a bank and sit down and tell them you want a mortgage, because they will tell you what they can do for you. They won't tell you if there's a better option, better quote, better, cheaper money. They will tell you what they do. Good, bad, or indifferent, that's what they're going to tell you. A good broker will be able to compare the market. A good broker will tell you, will take you through the variable rates, take you through the fixed rates, who is actually offering the best options for your circumstances, because not everybody should or could have the same, and nor should they. A couple of banks are even now offering overpayments, even in a fixed rate. A lot of people say, listen, I want to go variable because I want to throw my bonus once a year into it. All of those things. You can now overpay while you're on a fixed rate with some lenders. Get yourself mortgage approval. If you're a first-time buyer going out into the marketplace to look for a house, the first thing I would say is sit down with a good mortgage broker, get yourself mortgage approved for the maximum amount of money that you can get, even if that's above what you want to spend, because you're better to have it available and not need it than need it and not have it. Most of the estate agents nowadays will be asking you for proof of funds to actually accept an offer. Now, terms and negotiation skills, that's a different conversation. Do not provide your proof of funds until you agree a price. That's all I would say. Don't tell them, it's like playing a game of poker, don't show your hand until you have agreed price. But if you're a first-time buyer, you're going out into the market to look for a house, get mortgage approval. That way you are in the best position to put in a cheeky bid and move quick. Here's the process, guys. Organizes your financial records. So I'm going to take you through what sort of paperwork that lenders look for as well. Contact us, contact your broker. Obviously, I'm going to say contact us. That's, well, I'm a bit biased in that, but you can't expect that. Get yourself mortgage approved. Pay your booking deposit. That's the first thing that the banks or the estate agents will be asking for. It's obviously refunded then if you don't buy your house. You need a bank valuation. We'll need to get the loan offer out. If you need a structural survey, that's the time to get that done. Contracts then sent to your solicitor. Loan conditions satisfied. Loan conditions could be life insurance. It could be house insurance. It could be the bank want to see this or the bank want to see that. That's in your loan offer. You need to satisfy all those. Money comes to the solicitor. Guys, all of that seems very, very simple. But all of that up to this point was taken between 3 and 4 months. From when you find your house to when you get the mortgage, on average was between 3 and 4 months. This is now shortened to about a month, because the likes of Nua have just changed the platform and the way things are done. Even the closing with the solicitors now is done online. So this model is getting a lot shorter and easier to try and get through. Paperwork's needed, and again, guys, this is where we spend a lot of time with people, because it's important that your mortgage package and your mortgage application is done as well as possible, because if not, they will be slowed up. The banks will be slower getting, and they'll keep coming back asking and asking and asking and asking. And anybody that's been through this will know this. It is very frustrating. So the kind of things they're asking for is photographic ID, obviously, address verification. And by the way, when it comes to address verification, if you're living in the north or living out of the jurisdiction and trying to buy a house in Ireland, they'll ask you for 2 forms of address verification from 2 different sources. So it can't be if you've got 2 accounts with Santander that you use that. No, there'll only be one from Santander and one from something else. Just be aware of that. They'll ask for proof of PPS, which obviously if you're in Ireland and working here, it's on your payslips. If you don't have a PPS, you will have to apply for one. So you'll have to get onto social protection for a PPS. They will ask you why you're looking for it. You need to show that you're actually getting a mortgage. The banks are actually asking for the PPS now before they give you a mortgage offer. So there is a little bit of work in that. There is a way around it. So if you're stuck with that, by all means, come back. I can help you with it. If you're married, copy of your marriage certificate. If you're divorced, excuse why I put those two together. I don't know why I put those two together, but I did. So if you're divorced, you'll need to present that as well. 6-month bank account on all accounts. Now, I'm saying that's traditional lending. The likes of Nua have now, if you've got access to your account, the way that they can actually log in and see it, you don't actually need the accounts anymore. But we still like to see them because I like to go through them to make sure that there's nothing on it that's going to cause us a problem. So if you're dealing with us, we'll still be asking for them. Most recent savings account statements. In fact, it's most recent 6-month statements for any account that you've got, including ones in the UK, America, all over the world, everything. It's like a CSI investigation, guys. It is frightening what the banks are looking at the minute. 12 months credit history report if you're living or working outside of Ireland. If it's within Ireland, they'll do their own credit history reports. The lenders get access to that. But they haven't got access to anything outside of Ireland, so you need to provide it. And they will stick to it, and they will ask you for it. If you're getting a gift from somebody, if you have somebody in your life, some wonderful person in your life that's willing and able to give you a gift, then there is a form that person needs to sign to say that they're not actually having any interest in the house. Gift has to make sense, though. I mean, your neighbor or your friend down the road can't give you 100 grand for you to buy a house. They're going to ask questions like this. Now, if it's mum, dad, brother, sister, obviously it makes sense. If it's somebody that's related to you, it makes sense. But if it's a mate and he's suddenly giving you 40 grand, they're going to ask questions. And plus the fact there is also a gift tax implication when somebody gives you a wad of dough. So just be careful with that. And again, seek advice. There is no problem getting it, as how it's presented can cause a problem. Paperwork needed if employed, salary certificate. We use a generic one, but each bank themselves will have their own. So AIB won't take a Bank of Ireland, Bank of Ireland won't take an EBS. So all of that. So just if you're shopping around your lenders, it can be a wee bit frustrating. It can be frustrating for the person that's filling out the forms as well for you. 3 or 4 recent pay slips. What I mean by that is most banks want 3, the likes of Nua want 4. If it's us, we'll ask you for 4 and then we can go anywhere. Most recent EDS. The EDS is the old P60. You get this now available on your ROS, on your Revenue Online service. If you're from the UK or working in the UK, if you're not working within Ireland, obviously it's P60s. Most of the banks will ask you for 3 P60s. If you're self-employed, 2 years accounts. If the accounts, and this is an important factor, and this is what can slow people off as well. If your accounts have got increased a lot over the last year, they'll ask you for a 3rd year, and they'll average between the 3. If it's consistent, then they'll just use the 2. So just be aware of that, because that can slow things up too. 2 years revenue notice of assessment, again, same as before. If there's huge differences in the numbers, they'll ask for 3. Confirmation from your accountant that all your tax affairs are up to date. That's you personally and your business. Most recent business bank accounts, obviously if you've got a different business account, and 12-month statements for any loans. Now, if you're self-employed and you're paying finance, even if it's for the business, because you are responsible for it, they will take the business loans into consideration against your lending, against your ability to lend. So repayments even for van loans, for finance loans, does come against you when it comes to borrowing. If you're building, if you're self-building, we're looking for breakdown of costs, copy of your architect's PI, gift letter if you've been gifted a site, copy of planning permission, and a copy of the OSI map. That's generally what people are being asked to get, guys. Now, it's not an exhaustive list, because if there's quirky bits in your life, then there's going to be extra stuff asked for. But it'll give you an idea. The important thing is you're sometimes better to overshare with your information than undershare, because if the banks find something and find a question, they will not move on until it's answered. So for us, when we're making a mortgage application, we do the CSI investigation before we present to the bank at all, because it is slow and tedious if we don't. So it's quicker just to have a conversation with you that there's 3 or 4 pieces that's missing. There's 6 or 7 questions. There's money coming into your account that we don't figure out where it's going, or coming in from, money going to your account that you haven't told us where it is. Things like regular payment go to your bank account on the 15th of every month. You're going to be asked about that. If there's money coming into your account, even smaller monies on a regular basis, but you're paid from your employer BETF and you haven't told us that you're doing anything else, you're going to be asked about it. So it is like a CSI investigation, and it is frustrating. So again, guys, get advice. Talk to a good mortgage broker. They will make the job a lot easier. But guys, I'm kind of conscious of time, and we're going to get to some of your questions, but this is one Matt sent me in earlier, and he said, listen, we have bought a site with our own funds and we're going to build a house on it. He was hoping to use this as a deposit when applying for a mortgage. And can I deal with this? First of all, can you do this? Absolutely. The fact that you've got a site, that is your deposit. You don't need a wad of dough as well, Matt. If the site, now remember, if you're first-time buyers, it's 90% loan to value. So as long as the overall borrowing amount is less than 90% of the end market value of the house, you can borrow up to 100% of the build cost now. If you own the site, it's done, it's dusted, it's yours. That is your deposit. So if your build costs all work out and they're in with your max lending, and go back to the calculator again, you can borrow 100% of the build. Now, what I'll say to you on the builds at the minute, most of the banks, depending on where you're going, have a figure that they will not go below. Bank of Ireland, EBS and Permanent TS, Bank of Ireland, EBS and Haven Mortgages have just increased theirs to somewhere about 140 euros a square foot. Permanent TSB, 160 euros a square foot. I believe Bank of Ireland is going a bit nuts at 180, 190 euros a square foot. If you're coming in below these numbers, there needs to be a very good reason, and you need to be able to explain this. So just be careful with that one. How long will an AIP last? 6 months for most. AIB, Haven, EBS have just moved to 12 months. So I would imagine that all lenders over time are going to move to 12 months. So if you get your mortgage approval, generally that'll last for 6 months, push it out to 12. As long as your finances hasn't changed though within that period of time, there's no reason why you won't get approved again. So even if it does run out in 6 months, there isn't any issues in getting you reapproved. The important thing is not to feel under pressure to agree a house because your approval and principle is about to run out. Never buy a house under pressure. Never. Let the damn thing run out. You'll get approved again. Can I get a mortgage of Éireann sterling? Absolutely, yes. 50% of what we do here is based around that. We have people that are working for companies all over England that are now living in Donegal, living in Ireland. They're earning in sterling. We can do this all day long. I have people in Derry all over the north trying to buy in Donegal, trying to buy in Sligo, trying to buy around Monaghan. We do this all day long. 50% of what we do, absolutely. It's not easy. And a lot of people tell you it can't be done. It absolutely can be done, but you've just got to know what you're doing. Lenders are restricted to what you can actually borrow because they'll reduce your income by 20% or 15%. You've only got 4 or 5, you think you've only actually got 4 lenders, but it can be done just as long as you get to somebody that knows what they're doing. What else should I bear in mind when taking out a mortgage? Costs would be the big one. 1% stamp duty if you're buying a house. And that's on the purchase price. Solicitor's fees, depending obviously on the value of the house, I would tell you to budget anywhere between 2,600 and 3 grand. If you're buying a house at 500,000, stick another 1,000 euros onto that. Valuation fees for lenders between 150 quid and 220 quid, depending on the lender. Generally, that's it. There isn't any other hidden fees. Most banks don't charge arrangements fees for first-time buyers and switchers. Now, if you're an investor and want to buy property for investment, slightly different in that they do charge fees. Some lenders do charge for that, but generally not. So guys, I'm going to take a look and see what else is here. And again, I do apologize about the mess around later on. Okay, Sean, that's okay. Looking at current borrowing for property in Donegal, Carrigart, Downings area, are properties selling for more or less than the asking price? Great question. Generally, what we find is it really depends on Downings and Carrigart in that area, to be honest. It's a kind of an anomaly. They are going over the asking price. And again, sometimes it can be down to the estate agent that puts it on. Some estate agents put it on just to gain interest, and they know the value is going to shoot up. So what I would say to that is set your budget. I mean, if the house is on at a certain price and well, listen, I can go slightly above that, but set your budget. It's like buying anything. Don't get carried away just because it's a good idea. Set your budget, make sure you can get the lending, first of all. And when it comes to auctions, guys, whole other thing. Be very, very careful using auctions. But yeah, house prices generally anywhere at the minute, to be honest, if they're mica free, if it's a good area, yeah, they can go above the asking price. But get yourself mortgage ready, get yourself mortgage approved. Then you can put in a cheeky bid because you're ready to rock, you're ready to go. So you're kind of ahead of the person beside you if you can get yourself mortgage approved and ready to go. Okay, yes. Thanks for confirming that I was making a hames of it, guys, and that you could see it. Thank you. Okay, for the stress test and costings related to children, where do each bank come in with the figures? Okay, it's a good question. On average, the net disposable income amount, guys, increases by 250 euros per child. So what that means is that for every child you've got, the banks take away 250 euros of your affordability for mortgage. So in other words, a person with 2 kids, a married couple with 2 kids will borrow less than a married couple, purely because there's 500 quid a month that you have to allocate to pay for your children. That's not there to pay the mortgage. We can see your slides. That's great. Thank you very much. I think we were sharing the wrong screen. We're all good now. The yellow calculator is back. Great presentation, by the way. Thank you. We're all back. It would have been a brilliant presentation if I hadn't messed it up. But anyway. Are new mortgages open to non-residents, or is Haven still the main lender? What are the current rates? Okay, great question. Yes, they are. Haven isn't the only lender. Haven's a very good lender in this, and the reason that we personally would use Haven quite a lot is, one, I have them nearly trained. I say nearly trained, it's still seriously frustrating. But I have them nearly trained as to how this can be done. And a lot of it depends on the underwriter you get within the banks, and you can't actually dictate who you want to talk to. But in terms of non-residents, and again, it depends on what you're buying and what's the reason. If you're buying to come to live in Donegal, there's probably 4 lenders. You have AIB, Haven, EBS, and Bank of Ireland. Mortgage Store actually is another brand of Bank of Ireland that just announced that they're starting to do this as well. If you're buying for investment, it's a different animal completely. Not everybody wants that. But if you're trying as a non-resident to buy in Donegal or anywhere in Ireland, we do a lot of that. Take advice though. Sit down and take advice. I've had banks to tell people I've had people in AIB told they can't do it. I had one bank guy rang me about 3 or 4 weeks ago from Dublin. He's actually in the UK, wants to move to Dublin, was told by a bank in Dublin that it can't be done. And sure, of course it can. And I was delighted to help him. Okay. We don't see the deposits on your screen. Apologies, guys. Deposits for first-time buyers, you need 10%. 10% needs to be, you need to show that you've got the 10%. As I said, it can be from a gift. It can be from your own savings. It can be from anywhere that's, it can be from. If you're a second-time buyer, if you're keeping your existing, it's a 20% deposit. All partners, okay, that's grand. You see the mortgage with the boss. What lenders look for in showing now? Don't want to do kind of okay. Guys, I'm just trying to go through all the comments here to see if there's any questions. A question here about Revolut doesn't have a bank account. Can we use Revolut? Absolutely. There's no issues with Revolut, guys. But you'll have to produce that. If you've got a GB Revolut, you'll have to produce that. A USA Revolut, you'll have to produce that. Can you borrow money to buy land while saving in a Help to Buy scheme? Does this Help to Buy scheme have to be used to purchase land if you don't have plans for a house? Okay, good question. You can't use the Help to Buy scheme to buy land. It has to be to buy a site to build a house. You can't do it in any other way. Is it easier for non-residents to borrow for a self-build in Ireland? No, it's not. In fact, you probably won't get it. It is very, very difficult to build a house if you're a non-resident. Most lenders won't do it. Does equity release apply to people who own property in Northern Ireland? I don't know what the question is there, guys. Northern Ireland, we can't lend in Northern Ireland. Generally, lenders here won't lend for anybody in Northern Ireland and vice versa. So I'm not quite sure what the message is, equity release. But in theory, if you've got a house here, you're from Northern Ireland, can you equity release? It'll be done on a case-by-case basis. It's not easy. They're not queuing up to get it. And the likes of Nua don't do it. They don't do non-euro income. So yeah, you're restricted to the number of lenders, and they kind of do what they want and kind of say no to what they don't want. Look at the current borrowings for property in Donegal, Carrigart. Are properties selling for less or more than they've asking price? So we've already answered that one. Sorry, I accidentally bumped that. Prices up 10% this year. How do you see the future? I see the future of prices in Donegal continue to rise. And we say this quite a lot in Donegal, that we are different up here, but we are, insofar as the number of new properties coming on stream is very low. The amount of demand is very high. A lot of the houses have got mica. A lot of, well, and mica is not even the biggest problem now. It's pyrite and pyrrhotite. So there is a lot of issues in Donegal, but the biggest one is supply and demand. And whilst there is no supply and demand is high, house prices are going to continue to rise. Now, will they continue to rise in the way they're going? No, they won't, because lenders are kind of getting to a point where they're maxing out. So when it gets to a point where people can't borrow, that will drive the price of the houses, or they'll stagnate them. But they're not going to be falling anytime soon. So if you're thinking about getting into the property market, what I would say is don't wait too long, because I don't see anything in the future just to drive properties down. Do you have a recording of the presentation tonight reflecting? Yes, it will be recording, and yes, you will get access to it. If you get a mortgage to live in the house, but in 6 months' time decide to travel and rent the house out, is that allowed? There's two things in that. It's a good question. I need to be careful how you answer that one. When you're asking a bank for money, they are in control of the process, and they are in control of what happens. But when you have the money, you are in control of what happens. You're also in control of the information and the amount of information that the lender has about you. So if the lender doesn't know that you're off traveling and living your best life in Abu Dhabi, and they're getting their money, they're not going to ask. So I can't tell you not to tell them, but I'm also not telling you to run out and tell them. So you can make up your own mind on that one. You can read between the lines. You're in control of the information. As long as the banks are getting paid, they generally don't care. I see someone wrote a question in the Q&A box as well. Okay, good on you, whoever. Thank you. Do the banks in Donegal need a mica test done before getting a mortgage? Oh gosh. And now we're getting at it. Okay, two things. It is changing quite a lot, and mica isn't a big problem anymore. And that's been starting to realize. If you go to a bank and say, listen, we've got a house that has 20% mica, they're probably going to say, no, they don't want it. We are getting mortgages through where the mica content is low enough. They are lending on mica houses. They're just not shouting at that from the rooftops. We've had a couple gone through over the last couple of months where 5, 6, 7% mica on them. Absolutely no issue gone through. It is changing next year, and I know there is the lending institutions have a mica group together, and they're trying to get their head around this. They're bucking slow and doing it, but they're trying to get their head around it. They have to come up with something, but mica isn't the problem anymore. It's the pyrrhotite and pyrite is the issue. So mica isn't the issue, but it's getting the banks to move away from that at the minute. But if it's a low level of mica and the Newton quality of the block is strong, there isn't an issue here. It really comes down to whether or not you actually want to buy the house. Even if lending is possible, do you want it? So I would say to you, Emma, first of all, that's the question. Do you actually want it if there's mica there? If you have a mica report and you want me to have a look at it, send it over to me and I'll tell you what I think. But it can be done. It's not no longer a no-no. Let me just see the Q&As. Guys, is there any other questions or queries? Because I am very, very conscious of the time. I work full-time and I started a second part-time job that I now use to fund my normal day of living, and I'm able to save my salary. I know banks don't look at it fondly for someone starting a new business, so I am wondering if I should tell the lender about it. Good question, Anonymous. Okay, so if you're self-employed, then you generally have to be self-employed for 2 years. If it's self-employed and this is a second job, then it depends on how many hours you're actually doing the first job. So if you're working 70 hours a week, they're not going to lend in that total income because that's unsustainable. And as well as that, is there a history of doing it? It really depends, and I probably need a lot more information around that. In general, do we like second jobs? If you're doing it for a while, yeah, I mean, we can do it. But if you're working, 80, 90 hours in second jobs, they ain't going to do that. But let's say you're working 30 hours in one job and you're doing 12, 13, 14 hours in another at the weekend. That's not a problem. We can use that as long as we can see a history of it. It is doable. Also, I use different banks for different bank accounts. It doesn't matter. When you present for a mortgage, you're going to be asked for 6 months on all accounts. If you're in Ireland, they're going to run a credit check and they're going to see all your accounts anyway. The best thing that you can do is get to a broker and do not hide anything, because you will be found out. If not by the broker, if it doesn't come through, if we're going through your accounts and we see money leaving your account going somewhere, we're going to ask you. So if we see another account somewhere, even if you tell us there's not, we know there is. It's amazing what your bank accounts show. It's amazing what your finances show. And then when they do a credit check, everything's there. Even if your accounts are in the north, if we see money moving across the border, moving out of your account, and it leads to an account somewhere else, they're going to pick the thread, guys. So best thing to do is be open and be honest. A broker will help. They will not, shall we say, they will not help you hide stuff, but they might be able to help you present it in a way that's acceptable, if that makes sense. Should I say that there's a second job on my business, apparently 10, 15 hours a day? The issue, guys, is, so the question here is, should I say that there's a second job in my own business? Approximately earn 10, 15K a year. I can't answer specifics because I don't know the whole story. I can't tell you what to say because, again, I can answer generic questions in a session like this, guys, but if it's specific, obviously I can't, because I can't tell you how to do this. Does being on maternity leave affect what you can borrow? Will return to full employment after maternity? Good question, and it depends on the lender. Generally, no. Generally, I know for us what we would do in terms of that, we would get a letter from your employer to say, listen, here's your maternity dates. You're coming back to full terms and conditions again, and generally it isn't an issue. I have seen it a couple of times with some lenders, but generally there's enough lenders that will get you over there. So no, it shouldn't affect you. But again, if you're stuck, come back. 39 hours PAYE work, perfect. I don't know what else to say there. So guys, I think I've kind of come through all the questions and queries. And guys, again, I really, really, really do apologize about the mess up on tech. I have no idea what happened. I'm not great techie anyway, but I'm normally better than that. A couple of other questions. What is the capital gains arrangement if I'm non-resident and I later sell the property in the south? What is the capital gain allowance for non-residents? Is this based on the UK income? It's not about the income; it's about the profit on the house, and you have to pay it in Ireland when the property is domiciled. So it's based on what you've bought it at, what you sell it at, what's the profit. Do you know much tax on gift tax? Gift tax depends on the threshold. So very, very quickly, if it's mum, dad to you, to son, daughter, it's 400,000 euros. If it's your brother, sister, it's 40 grand. If it's a stranger and it's Mickey Joe down the road that you met in the pub that wants to give you some money, fair play to him. But if he gives you more than 20 grand, you're going to pay 33% tax on. So there's three bands: 400 grand, 40 grand, and 20, depending on who's gifting, will depend on what the threshold is. But anything over said threshold in your lifetime, not in one episode, in your lifetime, it's 33% tax. I have seen a house with no levels of mica, however, it is sulfite present. Do you know what the impact of this on the structure? And an answer, no. It's an engineer. All I can do, guys, is help you get money. If you want to get in debt, I'm your man. If you want to talk about the structure of a house, I'm definitely not the man. Talk to a structural engineer, talk to a builder, guys. It's not my gig. Helping you get in debt, even helping you get out of debt, that's my gig. Helping you get life insurance and pensions, all my gig. The rest of it, guys, I can help you get in touch with the right people, but it's not my gig and I won't advise you on it. Do banks in Donegal need MICA tests done for giving a mortgage? No is the answer. They don't need a MICA test, nor can they tell you to get one unless the valuer that they send out says that a MICA test is recommended. So there's a box on the valuation now and it says, listen, is there evidence of mica or pyrite or pyrrhotite? And if he ticks yes, they will ask for a MICA test. If he does not tick yes, they will not. It's not a blanket. So they can't unless they give it for the whole of Ireland. So they can't suddenly pick on people in Donegal. Guys, any other questions? Because I'm very conscious of time and I overshot the runway with it. So I appreciate your patience, guys. And I really, really do apologize about what happened tonight. It will not happen again. I hope I need to go away and do some more training. Guys, appreciate it. Tune in next month. There'll be another webinar. If there's anything as well, guys, that you want me to deal with, by all means, give us a shout. Tell me what you need, and I'm more than happy to do a presentation on it. This presentation will be available. It will be fixed up, but it will be available. So anybody that wants a copy of it, it will be available on our YouTube channel. There you go. Didn't even know we had one until a while ago. My social media people, there you go. So it will be available and we can send you a link as well. So guys, thank you very much for your patience. I hope you got something out of it and keep tuned for the next one. Bye for now.